the key will be watching to see how the yield curve moves. And if we get to an inverted point, as they say, the clock begins.
Joining me to share his insights on the REIT capital markets is Chris Lucas, Managing Director and Lead REIT Analyst with Capital One Securities. Now, there's a lot of concerns and rumblings about the possible next recession. How likely do you think that is, and when do you think it might occur?
What we're looking at right now is an environment where the Fed is clearly trying to either talk us or, through its policies, drive growth lower, to try to drive inflation lower. The question becomes, are they going to be able to navigate a soft landing, or based on all of the other activities that are going on, the geopolitical issues, the burn off of their balance sheet, the withdrawal of fiscal stimulus, whether or not rate increases in this year will lead to an overshooting of tightening and create a recession. Probably not this year, but likely next year. The key will be watching to see how the yield curve moves. And if we get to an inverted point, as they say, the clock begins.
Given that macro backdrop, how do you expect REITs to perform this year? Do you expect them to beat or trail the S&P 500?
The way we look at REITs right now on a relative multiple basis, it appears to us that REITs are undervalued compared to where REITs were trading to the S&P back prior to the pandemic. So if we think about that environment, which was a raising rate environment with good growth, if we think about that and then we add on the geopolitical risks associated with S&P earnings, I think we get to a point where we feel pretty good about REITs' ability to outperform this year relative to the S&P. Call it somewhere in the 10% range.
And drilling down to specific sectors, which ones do you think will outperform as well as possibly underperform this year? What we've seen is investors sort of last year sort of positioned early for recovery, sort of the reopening trade. And then as the inflation issues became more prominent, they clearly positioned into areas like apartments and industrial, which have very tight supply-demand dynamics with large rent growth opportunities to them, but they traded a high multiple, right? And the areas that were sort of disadvantaged, poorly performing, or underperforming, should say, net lease, things that had longer duration to them. We think that reversion to the mean trade is occurring now as people start to get concerned about, they balance their inflation concerns with their concerns about future growth. So for us, I think the back half of the year probably looks pretty good for longer duration lease investments relative to sort of the shorter term. And finally, we're coming off a very active year for REIT M&A. What level of activity do you expect this year? And would you expect there to be more deals in the public to public or public to private area?
I think, a couple factors there. One is that we have the non-traded REITs and the Starwoods and the Blackstones and the KKRs that are raising a ton of money, and they have and it's coming very fast for them. So their need is to invest. And so the large pools of assets that are out there include a lot of public REITs. So could there be some activity there? Absolutely. We've seen a bit of that already. The public-to-public stuff was clearly more strategic last year. I guess my sense is that some of what happened in 21 was a little bit of stuff that was hanging out from COVID, from prior, and just sort of got to the point where the market was clear. My sense is that a year similar to last year would probably be appropriate, but it would be more focused on, I think, the public to a private structure, more cash buyouts essentially than last year.